can't emphasize enough how much managing losses is very important and how much technical analysis is key to helping you do that. Let me give you an example. If you guys lose half of your money, hypothetically speaking, if you lose half of your money, that's a 50% drawdown. How much money do you need to make to get back to break even? Do you need a 50% return? You need a 100% return to get back to break even. When you lose 20% of your capital, how much return do you need to get back to break even? You need around 25. If you lose 10% of your portfolio, how much return do you need to get back to break even? You need around 11.1%. Thereabouts, give or take. You lose 5%, you need 5.5% back. The insight is, it takes more energy to make money than to lose money. It takes more energy to make money than to lose money. Which means that you're working so hard trying to make your money compound for you, that the first secret, the first technique that you should simply be dealing with is making sure you control your losses. And I will submit to you that from a discipline versus discipline point of view, technical analysis to fundamental analysis, you ask me, which person will do better over the long run? I'll always say technical analysis. And the first reason I will always give is because technical analysis helps you keep your losses small. While if you look at fundamental analysis, the primary way that they use to manage risk is through diversification. Diversification. The primary way that technical analysis uses to manage risk is through cutting losses. And cutting losses, ironically, taking a loss while they're small is a more robust way of managing risk than diversification or other risk management strategies out there. So what's a rule? Typically, the rule that we teach, at least in our trading school, is that when you take a loss, you should never allow a loss in a single stock. Whether you allocate 5% of your portfolio, 20% of your portfolio, or 50% of your portfolio into one stock. Typically, we always advise not to let a loss become 1 to 2% of the whole portfolio. Let's say, for example, you deploy, it's a 1 million portfolio. You deploy 10% in now. 1 million, you deploy 100,000 in now, right? And then that now drops down 10%. So the 100,000 drops 10%, you're now losing how much? 10,000, right? So typically, when that loss reaches your predetermined maximum loss, whether it's 10% or 1% of the portfolio or 2%, it's an automatic cut. Because you want to be able to make sure that you keep yourself in a position where your portfolio is still healthy enough to make the returns when you decide to make the returns, when the opportunities come, right? So that's always very important for us. It's always very hard to get back, especially in the stock market. If you think about it, there are only 4 possible outcomes, whether you buy or sell a position. The 4 possible outcomes are: you can have a small gain, you can have a big gain, you can have a small loss, or a big loss. Those are the only 4 outcomes. Now, let me ask you, what out of those 4 are you in control of the gains? Can you control how much gains that you make? Of course not. But can you control how much losses you can make? Of course, you can control it by cutting. So for us, professional traders and money managers alike, when we manage money in the stock market, a small loss, taking a small loss is business as usual. right? When people say, okay, nag-cut ako ganyan, it's normal. But the only time we get into trouble is if we allow a loss to hemorrhage into a big loss. Because small losses are acceptable, big losses aren't, right? Going back, that's essentially the reason why we want to be able to operate disciplinedly. Because your risk management, what you're able to control, whether it's a small loss or a big loss, begins at your point of entry. It begins when you decide to enter. Why? Because if you decide to chase prices, it sets yourself up for cutting bigger down the road. If you're able to operate disciplinedly, buy when it's quiet, or buy at least when prices are close to those levels, if prices go down, then when you cut, you're cut smaller. What if you buy it on support, and then during the day it breaks that support, and then at the end of the day it goes back above the support? Do you cut it within the day, or do you cut it at the close of the day, right? Generally, the rule that I follow is I follow a close of the day, right? This is generally speaking, meaning I buy a position if I have a few positions that are already breaking below my support, then I'm already watching them very closely. They're within my focus, right? However, there are going to be some instances where, for example, within the day, prices are breaking down your position. But at the same time, you're also seeing across the board stocks breaking down across the respective supports as well. Maybe the index is breaking down. Maybe there's an announcement that you need to consider. Maybe the Fed raised rates unexpectedly, and all of a sudden foreign funds are moving out, and that's causing prices to drop down. Or let's say it's just a negative announcement. It catches the market unexpected, and prices are breaking down on volume during the day. Then at that particular instance, I would already start cutting. But generally speaking, let's say prices break down below my support, especially if it's an illiquid stock, like maybe, for example, Pizza, maybe CHP, East West. I mean, legit companies, but somehow illiquid. If it's breaking support within the day, while I see the whole market holding, there's no general reason for prices to break down, then I'm gonna wait until the close of the day. And I also want to see the volume that's happening, the volume present during that breakdown. But generally speaking, I would wait until the close of the day. These support and resistance levels that I'm showing you are also what we call pivot points. Pivot points, which means that they break below, we cut it. They bounce above it, then we add some more, right? So these are pivot levels, meaning it's a pivot that determines two opposite actions. If it goes above the pivot, then we add. If it goes below, then we decide to cut. Yeah. Well, in the case of an uptrend, you need at least a low, a high, a higher low, and then a higher high. So you have those 4 data points that you need to be able to consider an uptrend. Now, when it comes to the lows, you need two pivots. So you need your low and your higher low. At least 2 support pivots to see if you have a bounce of support. So later on, I will also be teaching you some techniques that you can use to already participate in the first higher low, even before the higher high happens. So that's essentially, I'd say, the gist and the meat of how stocks are entered. If you look at how stocks are sold on the corollary, selling is most ideal as it bounces off resistance. So you have resistance here, whether it's a support, a sideways pattern, or let's say you have an uptrend line here. The line that connects the highs of your resistance is the line that connects the highs is called your resistance. As prices are reacting off of that, that's also a justified window to at least lighten or sell some of those positions, to sell a portion or sell those positions. So for me, every position that I have, I'm always cognizant as to where my pivot points are. As to where my pivot points are. Should I be cutting? Should I be adding? Should I be selling? What are the prospect positions? What are their pivot points? Para at least when they enter those pivot points, I'm already executing. I'm executing already. I'm already prepared. I'm already executing. Selling is most ideal either at the bounce of resistance or at the breakdown of an area pattern support. When you have a breakdown of an area pattern support, as I mentioned earlier using the CHP example, what is a breakdown a beginning of? A breakdown, and you guys might want to write this down if you haven't still, a breakdown is a beginning of a downtrend, while a breakout is a beginning of an uptrend, right? And the reason why breakouts and breakdowns are very important key events that you should be cognizant of is because obviously in uptrends, you want to participate at the end or at the beginning of uptrends. Syempre at the beginning. So beginnings of uptrends, you'll always see, or at least you'll always, a lot of uptrends start out with breakouts, or at least a good portion of those. But at the same time, downtrends often begin with, or sometimes begin with, breakdowns, and you want to steer clear of issues like those. So this is I would say this is the most important slide here, only because it gives you already how to enter a particular position, and more importantly, it gives you the big picture as to how money is made using technical analysis. Because most customers, or at least most people that I talk to, after they buy a position, they cut it, and they come to me and say, Javi, nagcut ako ng ganyan, ganyan nangyari sa akin, ganyan. But people don't understand that cutting losses is really part of the game, right? That it's really part of responsibly trading in the market.